then Deputy Cullinane indicated.
Gurmalgat, and welcome first of all to our witnesses, Mr. Kelly and his team. There's three areas that I wanted to focus on. The first is GDP and the relationship between GDP and borrowing costs. The second is the Strategic Investment Fund and the European Investment Bank and issues around that. And thirdly, the National Development Finance Agency, or what was the National Development Finance Agency, is now, I understand, one of your competencies. It's one of your new mandates. Is that right? Okay. If I start first with the GDP issue, what effect do you think the revised GDP figures will have on our borrowing costs, if any? Have you given any thought to that?
I suppose a couple of impacts. First of all, just the market impact of the surprise of the statistics. I've already said at the time that we fielded a lot of calls from investors. Post the number, and so there's a lot of explaining to do, and if you're explaining, you're losing really to some extent. So I think GDP. As a statistics, and therefore the debt to GDP ratio and other ratios that we use that include GDP are less valuable today than they were a couple of weeks ago, because they have been, if you like, distorted and are more difficult to explain. So investors that we've been speaking to are already just moving on to look at other indicators of our economic health, ability to repay, rather than that traditional ratio of debt to GDP. So I think it's less valuable as a tool than it was, and I think whether we economists come up, or the CSO come up with some new series that is GDP X the distortions, and maybe we can go back to having some confidence in that. But for the moment, investors are looking at other indicators in terms of looking at the economy.
Well, many people would see it as a bit more than a lot of explaining has to be done. There's disbelief internationally from a lot of economists. A lot of the international reporting of the growth figures was that they were more than just distorted, that they don't form the basis upon which decisions can be made. And we know that the GDP figures have an impact on the implication of the fiscal rules and debt to GDP ratios and all of that. But in terms of borrowing, obviously fund and asset managers, and they hold 50% of government debt, have to have confidence in the figures. And it's interesting that the language that you use is very similar to the language that the CSO Director General, Pádraig Dalton, used at the McGill Summer School, where he said that GDP and GNP, although required internationally, no longer provide a sufficient understanding of the domestic economy. But that's only because the figures are, we can say, distorted, or the figures are not real, and we're not being presented with what are the real figures. Surely that has to be a real concern, because as we know, GDP and GNP are the figures that are used internationally. They are the figures that investors look at. So what I'm hearing from you is you're accepting that fund managers and asset managers are concerned, have been in contact with your office, are expressing their concerns about these figures, and surely that's something that needs to be addressed.
Well, insofar as it needs to be addressed, we are addressing it by engaging conversations with them and trying to clarify their questions. But I think, to a large extent, I don't disagree with what you're saying, Deputy, in relation to those figures, GDP, GNP, have been distorted and are less useful. There's no doubt about it. But if you look at our investor pack that we take out on the road, to which we're constantly on the road with, and it's available on our website, updated every month, it probably has 40 different economic indicators in there, of which the debt to GDP is one, and maybe GDP makes up 3 or 4 of them. So investors always look at, and these are big decisions that investment managers have made. They're looking right under the hood, under the bonnet. They're getting in there and taking a look around. They're looking at 20, 30 indicators to make sure that things are what they seem, and those indicators. So, and it's the combination of indicators that will give you the overall picture.
But you also have to explain, and you said that you've had calls from investors, so you've had to explain the GDP figures, and you used the word distortion yourself. So when you use the word distortion, what do you mean by it? In terms of the distortion of the GDP or GNP figures, what's your understanding of what the distortion is?
What I mean by that is that the debt to GDP ratio, as traditionally used, the reason that it's used as by bond investors in particular, is that as your debt to GDP ratio falls or improves, the assumption is that your ability to pay your debts and refinance your debts is improving simultaneous with that, and that's why it's used as a good indicator. In the case where an element of the GDP growth has no economic value on the other side, therefore your ability to repay and finance your debts are no more improved than they were before the number, then it's less valuable as a tool for investors to use, because it's not necessarily because of that distortion. In this case, it's been told to us by the CSO that it's not necessarily matched with actual economic activity, and therefore your ability to repay and refinance isn't matched in the way that it ordinarily would be in the case of the GDP growth in the past.
And do you then have any role in terms of reporting back to government departments, the CSO itself? So you're on the front line in terms of, from the borrowing side, asset managers, fund managers, you've got these requests in, you've had to explain, you've done all of that, you have your own view of what the issues are. So I'm assuming then that you have also some responsibility to report that back, and you might just talk us through what then that involves, or is there any reporting back from your perspective?
Well, we have a very close relationship with the Department of Finance, and we would give feedback, always on any material issues straight through. We've got a very close working relationship. Secretary General is on the board of the NTMA as an ex officio member, and so there's regular contact and a very good relationship. All that feedback goes back and forth. The CSO are independent, so that's a separate matter.
But do you engage with them?
No.
And do they engage with you?
No.
Would that be useful, given that they calculate the figures?
That's really a matter for them. Yeah.
Okay. If I can move on to the SIF and its relationship with the European Investment Bank as well. I suppose the first question I have is what your definition of investment is here, and what criteria is used to determine whether or not a project should be funded.
Yeah, so what we describe as the double bottom line to get through for investment, to get through the pipeline and ultimately through the investment committee, it must have demonstrable economic impact, and it must have a commercial return. Now, that commercial return, is risk adjusted, is proportionate. So certain types of transactions obviously would demand a higher return than others, and we decide that criteria based on similar other investment opportunities and peer comparisons that are out there, and then the blended return is the return that we will get from all our investments together. Ultimately, that should exceed the cost of borrowing. Otherwise, the state is not benefiting.
Okay. There was a report published by the European Commission, the EU Urban Agenda Toolbox, and it looks at the workings of the European Investment Bank, and it does a similar job, I suppose, to the SIF, and it talks about building your sustainable community. There's a section in it where there's a reference to the office in Poland, okay? And it says, the first time the EIB bankers came to discuss Warsaw's extension to its small metro system, they did not ask the questions that the Deputy Mayor expected, which was, a commercial banker would have asked, will you be able to pay me back? The EIB wanted to know why they needed a metro. And it goes on to say that the Mayor was impressed by the fact that the EIB wanted to be sure the city was taking the right decision financially and in relation to EU policy goals. Quote, the EIB is not just there to finance a project, but also to help solve the strategic challenges of the city. Once they approve your project, you have a real proof of concept. And there seems to be, in my view, a different approach taken in respect of the SIF, which is a very heavy concentration on a commercial return. And I'm not so sure that's the best approach to take. And have you looked then at how the EIB sees investment as opposed to how you would see investment or your organisation would see investment?
Yeah, first of all, you're right. But our mandate is given to us by the Oireachtas, so we do have to meet that commercial return, and that's part of our mandate. So we wouldn't be able to change that unless it was changed for us. So for the moment, we have to meet that hurdle and have a commercial return. The EIB obviously is a huge institution, and in terms of the Juncker plan and what it can do and what it's trying to do, is very interesting, and where projects in Ireland can link up and associated with them, then we're happy to do that. I think the National Development Finance Agency has linked up on a number of occasions with some of the new EFSI funds, and both in terms of GCU I mentioned, and the primary care project has also linked with that fund. So it's a very interesting fund. It's not a fund that I'm an expert in, and I don't have any. I wouldn't want to be quoted on it necessarily, but clearly they're trying to do similar things, which is use fiscal stimulus, direct investment in infrastructure, in economies, to do what I suggested earlier, which is that to make up for the policy, which is not doing what some people have thought it might.
Okay, well, you've said that a commercial return is a heavy part of the blend, and that's the mandate that has been given to you by the Oireachtas. But mandates can change if the mandates are too restrictive. And again, I'm assuming that as this is a new fund, it's establishing itself, you have to evaluate its effectiveness. And in doing that, have you or your organisation formed any opinions on maybe a need to change the mandate? To make it more flexible? Is it flexible enough to meet the demands of the state in terms of investment, in your view?
Yeah, I think Debbie, for the moment, going back to the earlier question, the pipeline would indicate that for us there are a lot of very interesting projects sufficiently, and that we're having very significant economic impact. The multiple that we're getting, Deputy, on our money, like 2.5 times the money that the ISIF is investing, because of its need to have co-investors. So you're multiplying that 2 billion that's been invested in the economy is multiplied by 2.5. So it does have that additional impact, which an EIB fund wouldn't necessarily have, that direct money going in. So provided we're seeing that multiplier, provided we're seeing the pipeline of projects that we think are viable, then, although we are conducting a review and will continue to review, I don't necessarily have a strong view that way, or wouldn't be inclined. But if we get to a point where we're not seeing the pipeline and it's drying up a little bit, I think you'd have to review it in the light of maybe changing, and maybe you might have to have that conversation.
Okay, the last issue I wanted to focus on was the former remit of the National Development Finance Agency and public-private partnerships. And the important part of public-private partnerships is that we get value for money. And I suppose, first of all, it's important that information is given to us, to citizens, for us to be confident that we are getting value for money. So how does that work from your perspective?
Yeah, I think probably I'd say the PPP. Again, I'm relatively new to all of this, but my observation would be that the PPP projects are probably the ones we should feel most comfortable as citizens are value for money, because they've got to pass 2 or 3 different hurdles in order to get there. So initially, a sponsoring department, for example, would do a kind of desktop exercise as to whether they should do it themselves directly or go to PPP. If they decide that it's a PPP-able project, and some of these guidelines set down by the Department of Public Expenditure and Reform and the Department of Finance, it would then go to us, to the NDFA, with the sponsoring department, where the public sector benchmark, as it's called, is constructed. And that's constructed together with all of the methodology around capital cost, not just the capital cost, upfront cost, but of course all the maintenance and servicing costs over the lifetime of that project, all the methodology. And so that bar is then set, if you like, that public sector benchmark is set. Then the procurement process starts, and if the preferred tender or preferred bidder comes back, it has to come back below that public sector benchmark. Otherwise, it won't go to the next stage. So you have that test there. Then, before it gets to financial close, which is probably 6 to 9 months down the road, it must again, before financial closing, it must do a retest against the public sector benchmarks in case things have changed, any of the variables have changed in the meantime, and only then is it signed off and allowed to go forward as a PPP. So I think there are a number of tests there where it's you have to meet the criteria, and I think that's important. And
can you just give us a quick glimpse of what type of areas that PPPs cover? So what type of buildings have we used PPP? What type of areas have we used them in?
Yeah, I mean, I think the best example, maybe to use the best example I think out there now, and it has some of the characteristics. So we've just had financial close on the primary care, 14 primary care centres getting built around the country through PPP by Balfour Beatty, a big UK firm. So they've won that mandate, and that just at the financial close. It can't be revealed for confidentiality purposes, but the Controller Auditor General could analyse the project, and I think has done in the past. But it's a substantial discount to the public centre benchmark. So
well, I'll get to the CNAG in a second, but in terms of the type of areas that PPPs are prevalent in, has been so far things like schools, courts, nursing homes, which are a new feature, and now the public-private partnerships in healthcare as well. Yeah. But these are essentially tried and tested areas. Yeah. And one of the advantages, or we're told one of the advantages of PPPs is that there's a risk sharing. Yeah. So the state shares the risk, and the private sector shares the risk. But there isn't any real risk here in many of these projects. So in many ways then, that's something that I think that needs to be focused on more, because if the risk isn't there, then really these are lucrative projects for the companies themselves. So I've read the CNAG's report on PPPs, and there's some issues raised which I'll get to in a second. But in terms of their rationale, my understanding of their rationale is that they give value for money, risk is shared. But if the spend in PPPs are in tried and tested areas, then there really isn't much risk sharing going on here.
Well, I think first of all, there'd have to be risk sharing for it to be considered off balance sheet, and that test, as we know, in terms of Eurostat, gets continually assessed and tested. So, in that sense, as you say, there must be risk sharing, and that risk burden must be there. I think if you went back to the crisis. Many of the people who participate in PPPs and the construction companies and the financiers will tell you that there certainly is risk sharing, because all projects in Ireland were abandoned, and all of the people who were participating, whether they were investors or people who had people on the ground in terms of contracting and commitments, etc., were all essentially had to pick up and shut up shop. So they took a substantial risk and substantial losses, because they incur very significant costs in the bidding process and even preparing the resources. So I think that's where the risk certainly does lie with many of them.
Are you familiar with the model in British Columbia and regions of Canada, where they publish reports as soon as a project is signed up to a PPP project, and it sets out risk analysis, it sets out the complete 25, 30-year picture, and it gives information in terms of the whole project. It evaluates whether or not we will get value for money. It has to be justified. Everything has to be captured. Everything has to be justified. We don't seem to have the same type of process here, as far as I can see. So it seems to be a better model in terms of, because information for us is key. That's our job, is to evaluate information. And also on the same track in terms of information, Deeper's website is the place where we get a list of all the PPP projects, but it's 3 years out of date.
I'm not familiar with the Canadian model, but sounds like a good idea. It might be one for the Controller Auditor General to take a look at.
But Deeper's website being 3 years out of date, if it's one of our jobs, one of our functions is to ensure that we get value for money, that we understand PPPs, we understand their nature, the volume of them, how many of them are out there. If we're not given that information, if we have a department website that's 3 years out of date and doesn't capture or doesn't list the full PPP listings, surely that's a failure on the department side, and also that has an impact on your work, given that it's now one of your mandates. So, first of all, were you aware of the fact that it was 3 years out of date?
No.
No. And is it something that can be looked at?
I'm sure you'd have to maybe talk to them about it.
But it's one of your areas of competency now. I'm hoping that it's something you'll be able to.
I'll follow up
to help us with as well. Yeah. In fact, maybe if we can just ask the CNAG to comment on, because he has furnished the committee with a report as well.
I mean, certainly the kind of information that's on the website is really about what has been spent and what's committed.
Yeah.
I think it's useful to have that kind of information to know what is the level of commitment in the future in relation to those projects. I think the question around the evaluation of the value for money is something that my predecessor and I have commented on, and that is around, if you like, explaining publicly where the value comes from in a public-private partnership. The concern I think that we would have is that if there is a succession, I think let's use an example of the schools, where a succession of projects have been put out and developed under PPP, and effectively somebody who has been successful in bundle 3 knows what the commerciality of the deal is, and if there isn't some explanation to allow others, if you like, to understand, what we're looking for, what kind of value we want, then, in my view, there's a risk that you're limiting the potential for competition in the market. So I think publishing something, it might not necessarily be the full value for money benchmarking exercise that Mr. O'Kelly has mentioned, but a cut-down version of that. And I think you're correct that there are examples of where there would be an explanatory memorandum in relation to a project, explaining what is the nature of it, what are the key risks that are involved, who's carrying what risks, the headline commitments in relation to it, and why it's a better way of delivering the services that we require than doing it by conventional means.
And just in terms of your
sorry, could I just say the flip side of that, or when the commercial sensitivity of it would be removed, is, let's say, after 3 or 4 years, when the project is up and running, and if you like, it's kind of settled down. There is a requirement, as I understand it, under the capital appraisal guidelines, that there be a look-back exercise to verify that, yes, the value has been delivered in the way that was expected. And my understanding is that no project that has been run, and they've been running since around 2003, I think, conventional PPP projects, I'm not aware of any exercise, a look-back exercise, having been published. So there is, I think, a dearth of public knowledge about how this works and why it delivers value, and I think it is something that possibly needs to be addressed. It might be something that would need to be taken up with deeper as well.
But because of how we do it from this state, the commercial sensitivity argument has been used to, in my view, to almost frustrate information that's given to committees like this. And even if we're not even using that, even after that 3 years, we're not getting the look-back reports. That's a problem. But I raised the issue of just doing some research. British Columbia is one example. Regions in Canada, I don't know whether if the CNAG's office is aware of those type of models, or other international models that are better at providing information. Because once a project is signed up to, it's signed up to. I'm not sure why we have to wait 3 years. But my understanding is in those regions, in those areas, they give a very comprehensive report at that. Are you familiar with?
Yes, I mean, I certainly would probably need to look again, but certainly I am aware in the past that those would have been published. I think a point has often been made here that the committee can be assured that value for money is being achieved because the CNAG can look at these projects. Looking at any one of these projects would take a full-time staff member a year for me. I don't have the resources that would allow me to give you the assurance that every single PPP project delivers value for money. So I think, if I look at it, I will report on it, and we have done in the past. But I think you need to be looking for assurance from the NDFA and from the sponsoring departments in relation to the value for money that they're achieving, and not assuming that just because I can look at them, that I have looked at them. I don't have the resources to do that.
And just the last question, and to follow on from what the CNAG has said and his observations, does Mr. O'Kelly think that there are areas in respect of what's been articulated there that can be taken on board by your own organisation.
Yeah, no, I think so. I mean, look, I think I'm very comfortable that there's value for money there and that they have to pass those tests and they're quite rigorous. I mean, finding a way to give that kind of transparency to this committee and to the public is probably something we should try and do. I think each project has its own project board, and there will be an accounting officer on there, independent, and there'll also be a member of the sponsoring department in relation to it. So there is transparency from they're all signing off. They're all seeing the value for money, if you like. So there is some comfort in that. But I think ultimately, finding a way to demonstrate that would, I think, be helpful.
Okay, and following what the Deputy has said, I think we'll formally write to DPAR asking them to provide whatever information they have in terms of a look-back audit on all the PPPs that have been engaged over since the recent round commenced in 2003 or 2004, and if they've no look-back carried out, why? And because it was a government policy, and let them come back with the answer and we'll take it from there. So we'll formally write to DPAR. Deputy Cullinane.